Welcome to Module 3 of Accounting 5000. In Module 3 we're going to start the first part of Chapter 2. Module 4 will be a continuation of Chapter 2 where we talk about the theory behind what we're going to do today. What we're doing to start out with in Chapter 2 are the financial statements. Remember we talked last time about how these were the pieces of information that were used by investors and creditors and other parties to make a decision. Where did that information come from? Well, the information in a financial statement begins with what we call an economic event. Something with economic impact happens. For example, let's say you walk into a local retailer and you purchase a shirt. That's an economic event. You are giving the merchandiser some money. He or she is giving you a product. Two things have happened. Money has changed hands and a product has changed hands. That's what we call an economic event. What accountants do is take that economic event and translate it into what we call a transaction. And a transaction is writing down what occurred in that economic event. These transactions then are summarized. All of the transactions are summarized into what we call accounts. And the accounts then in turn are summarized into what we call financial statements. So you can see it's a long process of summarizing things that happen. So, for example, take a large retailer that you know and think of all the transactions that occur in that retailer in just one day. Somebody has to take all those transactions, compile them into one sort of financial statements for the manager to know what happened that day. How much did he or she sell? How much cash did he or she collect? What else went on that day? Did they pay some rent? Did they pay some utilities? That's what's in the financial statements. And all those transactions are summarized in the financial statements. So what kind of financial statements do we have? What we're going to talk about in the next few weeks are four basic financial statements. The balance sheet, the income statement, the statement of cash flows, and the statement of changes in owner's equity. We're going to spend a lot of time in the next few modules talking about the balance sheet. Then we'll build on the balance sheet a little bit and talk about the income statement. And as we get a real good handle on those two financial statements, we'll branch out into the cash flow statement and to the changes in owner's equity statement. So let's start with the basic accounting equation. The basic accounting equation goes assets equal liabilities plus owner's equity. It's called the basic accounting equation. It is also the balance sheet equation. Now the reason it's called a balance sheet is because you can see there's an equal sign between the A and the L and the OE. That is always in balance. Never out of balance. That's why it's called a balance sheet. A must always equal L plus OE. This balance sheet is like a picture of a firm at a particular point in time. Think back to our example of the retailer who is selling shirts and various other things. At the end of the day, a snapshot is taken of that firm, and that manager will know what he has, what has occurred. What he has is a balance sheet. Picture of that firm at a point in time. Now it consists of three things again: assets, liabilities, and owner's equity. Well, let's take those three things apart, those three pieces of information, and define each one of them and talk about some examples of them. Remember earlier we talked about generally accepted accounting standards and accounting concept statements. Well, in one of the concept statements, assets are defined as probable future economic benefit. In other words, this is something a firm has that has value to the firm, something the firm can use in the future. For example, a car would be an asset. Clothing would be an asset. Those are things you have that have value. In a firm, in an organization, we can take those assets that have value and decide some of these are things that we're going to use in the next year, and some of them are things that we're going to use in the long term. Now, use yourself as kind of an example of a firm. The things that you're going to use quickly are the cash that you have in your pocket, perhaps even the cash in your checkbook. Those are things that you're going to use up within the next probably couple of days, weeks, or months. However, you have some other things, some other assets that you're not going to consume or use up within the next year. And those would be things like your car, your house, some of your stereo equipment. Those are things that have long-term value to you, but you're not going to use them up. We divide those things that you're going to be used up quickly and those things that you're not going to use up so quickly into two categories that we call current assets and non-current assets. Current assets are those that are going to be consumed pretty quickly. In a firm, we use 1 year as the break point. If you're going to use it up in 1 year, it's a current asset. Cash falls into that category because you're going to use it up quickly. On the other hand, the non-current or long-term assets in a firm would be things like their machinery, their buildings, their furniture. Those are things that they will not be using up in the future. So we're going to make a distinction between current assets and long-term assets. So when you're looking on a balance sheet, you're looking at the asset part of a balance sheet, you will see such things as cash, accounts receivable, merchandise inventory, prepaid accounts. Those are all current assets. Cash, of course, is cash. That's the money the firm has in the bank. Now, accounts receivable, that may be a new term for you. Accounts receivable are monies that are owed to you. For example, if you walk into a local retailer, let's just pick one, Penny's. You walk into Penny's to buy a shirt. And instead of giving them cash, you give them a credit card. And it's a J.C. Penney credit card. In exchange for that credit card, they charge it to your account. They give you the shirt. You now owe J.C. Penney's for that shirt. That money that you owe J.C. Penney to the firm, to J.C. Penney's, is called an account receivable because they will be receiving that money from you in the short term, within the next month or two. That's an account receivable to J.C. Penney. Okay. Merchandise inventory, you probably understand what that is. That would be all the shirts that Penney's has and all the shoes and bedding and clothing. That's what they have on the hand that they can sell. Prepaid accounts, though, may be a different kind of idea for you to understand. Prepaid accounts occur when a firm pays some of its expenses ahead of time. For example, a lot of insurance companies make you pay your insurance for several months at one time, perhaps even a year. Well, as you're going through the year, you have paid ahead of time on some of those things. Those are what we call prepaid accounts, expenses that you've paid ahead of time. The reason we put those in assets, because remember those are things we have of value, we will be using up that insurance or rent in the near future as an asset. We'll be using it up. So it's worth something to us right now. And if for some reason we were able to cancel the insurance or had to cancel the rent, they would have to refund the money to us. So it is worth some money. It has cash value. So that's what a prepaid account is. So those first four things on that list, cash, accounts receivable, merchandise inventory, and prepaid accounts, are all current assets. The other two on there, equipment and land, are long-term assets. They're still things that the firm has that have value to the firm. They will be using them, but they will not have used them up in the next year. Equipment may last 10 or 20 years. Land theoretically could last forever. So those are long-term assets. So you'll need to remember the distinction between current assets and long-term assets, because in Chapter 3 that's going to come into play when we start doing some analysis of our financial statements. So those are assets, things that we have that have value. Now remember back to the equation. Assets equal liabilities plus owner's equity. So let's just define liabilities. As you can imagine now, it's on the other side of the equation, so think back to your algebra. It's the reverse of an asset. This is a probable future sacrifice of economic benefits. These are things you're going to give up in the future. We also use the term obligations occasionally when we're talking about liabilities because you're obligated to pay something in the future. For example, when we were talking about the Penny's credit card charging the shirt, when you charged that shirt, that became a liability to you because you were going to have to pay Penny's for the shirt in the future. To you, that would be what we call an account payable. An account payable means you're going to be paying in the future to another party. It's an obligation. You also have things like notes payable. Now, notes payable can be either current or long-term. Some notes are due in 60 or 90 days. Those would be current because you'd have to pay them within the next year. But you can also have long-term notes. Your car note may be a long-term note. Perhaps you bought your car for 3 to 5 years financing. Part of that would be current. The part you're going to pay in the next few months would be current. The rest of it would be long-term because you're not going to pay it for several years. So those are things that you owe. The key word to remember when you're thinking about liabilities is the word payable. When you look at different types of accounts in a balance sheet and it has the word payable at the end of it, that's a liability. For example, accounts payable, notes payable, bonds payable, wages payable, taxes payable. All of those are liabilities, things that you owe in the future. So now your assets, the things that you have that have value, are equal to the things that you owe plus what we call owner's equity. Owner's equity is the right of an owner to what's left over in the firm. It's often called net asset or net worth. And I think you can figure out that concept fairly easily because remember your algebra, A equals L plus OE. Well, if you move the liability to the other side, it becomes A minus L equals OE, which means that your assets minus your liabilities equals your owner's equity. Now think about that for a minute. Your assets are the things that you have that have value, and if you subtract out what you owe, everything that's left over is the equity you have. It's what you own, the residual of your ownership. And that's exactly what owner's equity is. What the stockholders or the owners of the firm own after they pay all their debts from their assets. So that's what owner's equity is. So remember the basic accounting equation. Assets equals liabilities plus owner's equity. And when you're looking at a firm, owner's equity would be such items as common stock, additional paid-in capital, retained earnings. You will often see one called preferred stock. Anything with stock in it or retained earnings will be an owner's equity account. Okay? So that's the balance sheet. It's a picture of a firm at a point in time. What do we have, what do we owe, and what's left over? And it's dated as of a particular day. For example, December 31st, 2005. Here's what we had, here's what we owed, here's what's left over. That's interesting to a manager because he or she then knows what they have. But often managers and investors and creditors as well want to know, okay, what happened during the year for our firm, or what happened during the week or the month? In other words, they want to know what happened over a span of time. We call that an income statement. An income statement covers a period of time. The ones we're going to look at in here typically will be a year, but you can do an income statement for any period of time. Income statement shows you what monies were brought in by the firm and what was paid out. So there are only two categories of things on an income statement: revenues and expenses. Revenues are the funds that were earned during a particular period. Expenses are what was paid out to get those revenues. Not necessarily paid out, but things that you used up to get those revenues. Which brings up an important point in accounting. In this accounting class, we're going to be using, for the most part, what we call accrual accounting. Accrual accounting means that we show revenues when we actually earn them. For example, we would show the revenue, if we were JCPenney's, when we gave you the shirt and we collected the account receivable from your credit card. That's when it's earned. We don't wait till we actually get the cash for that. We show it when we earn it. We show expenses when they are used up, rather than when we actually pay for them. So you have to set aside the idea of cash changing hands in order to do accrual accounting. You think of when did I earn it and what did it cost me to earn that? Those are revenues and expenses. So an income statement, although it can be fairly lengthy, is really just two things. What did we bring in revenues, and what did we spend to get those revenues, which are our expenses? The bottom line, you've heard that term in accounting and business, the bottom line is net income. In other words, what happened at the end of that time? Here's the revenue, Subtract out our expenses. Whatever's left over is our net income, often referred to as the bottom line. Well, what are these revenues that you keep talking about? Remember, these are things that we have earned over a period of time from our normal business activities. Let's assume in this case that we're McDonald's. Our revenues would be all the monies we got in from selling hamburgers and French fries and drinks, all the other stuff they sell. We often call that net sales. In other words, this is all the stuff we sold. Those are our revenues. Now again, put yourself into McDonald's shoes. In order to get those sales, what did we have to incur? Well, we had to pay somebody to make the hamburgers and French fries, and we had to rent the building, and we probably had to pay some utilities. Those are expenses, the costs that we had to incur in order to get that revenue. Well, within the expenses, you will see a number of different categories. Cost of goods sold, interest expense, rent expense, wage expense, tax expense. Most of them are pretty straightforward. The one that you may be a little bit unfamiliar with is the cost of goods sold. And again, put yourself into McDonald's or JCPenney's shoes and think about this. You gave a customer something, a hamburger, a drink, a shirt. That, what you gave them, cost you something. You had to pay for that shirt. You had to pay for the bread and the hamburger and the pickles. That's your cost of goods that you sold. So cost of goods sold is really self-explanatory if you think about it. What did you have to buy in order to turn around and sell it to somebody else and generate sales? For pennies and the shirt, it would be very simple. What did they pay to go out and get the shirt? That's a retail firm. So they buy the shirt for $12, they sell it to you for $20. It costs them, their cost of goods is $12. Their revenues, their sales are $20. So you have cost of goods sold and revenue. For McDonald's, it'd be a little bit more difficult because McDonald's had to compile a number of costs to come up with the cost of what they sold you. They would have to figure out the cost of each pickle, how much lettuce, mayonnaise, mustard, the hamburger itself, the bread. All of those costs would have to be combined to come up with a cost of goods sold. So in some instances it's fairly simple. In others it's a little bit more difficult to compute. But it's the cost of what the seller is giving you as the customer in return for what you're giving them as revenue. Now remember, if you take your revenues, subtract out your expenses, you will come up with what we call net income, or the bottom line. It's simply revenues minus expenses. Now we also have a little quirky things that go in there too called gains and losses. Gains are very similar to revenues and losses are very similar to expenses. The distinction between those is that gains are things that you have that are not what you usually do, not in your usual course of business. For example, now think about McDonald's. Revenues were when we were selling we don't sell hot dogs, hamburgers, Cokes, and French fries. A gain would be if McDonald's sold some property that they bought and made a profit on it. The same thing with losses. That's when you have expenses over and above what you paid for it, and it's typically not something that you do in your normal course of business. For example, if you sold the property in your McDonald's, you don't usually sell property, but you bought it for $20 and you sold it for $15, you would have a loss on it. So gains and losses are very similar to revenues and expenses, except that they are not in your normal course of business. A couple of terms you may want to be familiar with when you're looking at the income statement. Be familiar with the term gross profit. Gross profit simply means the difference between your revenues and your cost of goods sold. You may remember a second ago we were talking about pennies where you bought the shirt. Pennies bought the shirt for $12. They sold it to you for $20. Well, the $20 minus the $12 would give them $8 in gross profit. That's the profit they made just simply selling the goods that they had already purchased. From that gross profit, then, they have to deduct salaries for the salespeople, rent on the building, taxes, insurance, and various other costs. Once they deduct those, they come up with what we call earnings from operations. They take their gross profit and they subtract out all the other costs of doing business and come up with income from operations. The last piece that you'll notice on an income statement is called EPS, earnings per share. What we do on an income statement is take our net income and divide it by the number of shares of stock that people have and figure out how much each share of stock earned, earnings per share. It's the last line on your income statement. Okay? So you have now a balance sheet and an income statement. Let's quickly go over the other two statements just so you're familiar with them as we go through and talk about some of these things. The next one would be changes in owner's equity. This is simply a recap of what happened to the owner's equity account. Remember, the owner's equity account is part of the balance sheet, so it's just really a recap of what happened in greater detail. And it shows where the money came from for if they sold more stock or if they made net income or if they paid out dividends. Those things are all just included in this changes of owner's equity statement. Again, it's just a subpart of the balance sheet, but it gives it in more detail. The other one that you should be familiar with would be the statement of cash flows. A statement of cash flows is simply what it sounds like. It's where the cash came from in the company and where the cash was expended in the company. In the statement of cash flows, we break them down into three types of things that occur: the operating activities, investing activities, and financing activities. The operating activities are things that the company does in the normal course of business, like selling shirts or hamburgers. Investing activities are things that a firm does with its cash, usually to generate more income, buying more equipment, buying stocks in another firm. And then financing activities are how a firm gets money in order to continue operations. If they have to borrow money or sell stock, that will show up in the financing activities. So those are the other two statements. We will spend more time on those in detail later on in this course, but we're going to focus right now mainly on the income statement and the balance sheet. And we'll come to deal with the other two statements a little bit later on. So in that vein, let's look at some income statement and balance sheet accounts and talk about some of the information that's included on a balance sheet and an income statement. What I wanted to do was to use exercise 2-2 in your textbook as an example of the types of information that are contained on those two statements. So if you look in your book on page 55, exercise 2-2, it lists a number of financial statement captions, and what they want you to do is to take those items that are listed there and first determine which category it would be, and then second, determine which financial statement it would appear, whether it be the balance sheet or the income statement. Okay, so for example, on the first one, accumulated depreciation. That's a term you haven't heard before. Let's talk about what it is, and then I think it'll become obvious where it goes. When a firm buys a long-term asset, let's use a car for example. Firm buys a car, they expect that car to last 5 years. They're going to use it over a time for 5 years. As they use that car, the value of the car to the firm is going to decrease. They're going to use up the usefulness of that car. So let's say they paid $15,000 for the car. They're going to use it for 5 years. And when they get through with it, it will just be a piece of wreck they can't get rid of, so it will have no value. So they would take that $15,000, divide it by the 5 years, and they would be using up essentially $3,000 of that car each year. As they use up that $3,000, they put it in an account called accumulated depreciation. Accumulated just means that they've put it all together, they combined it. So they've taken the depreciation for all the years and added them together. What accumulated depreciation is a deduction from the asset. So on the balance sheet it would show car, and then underneath it would say accumulated depreciation on the car, and they would come up with a net value for that asset, the cost minus the accumulated depreciation. So it shows up on the balance sheet in the asset category, but it's really a negative asset. It's what we call a contra asset. It's subtracted from or goes against the asset of the car. So although the answer says it's an asset and it shows up on the balance sheet, that's somewhat correct. It does show up on the asset category in the balance sheet, but it's a negative asset. It's a deduction from an asset. The next one you shouldn't have any trouble with, long-term debt. Anything that you owe somebody else is a debt, it's an obligation, therefore it's a liability. Liabilities show up on the balance sheet. So that was fairly easy. Next one's just about as easy, equipment. Something you have that has value, it's worth something to you, so it's an asset. And as you remember, assets show up on the balance sheet. Here's one that's a little bit trickier. Loss on the sale of short-term investments. If you're losing money, that's a loss because typically this is not what people do in their ordinary course of business. If it's a loss, then it's going to show up on the income statement. Here's one that's a little strange, and then it shows up several places. Net income. Remember, that's the bottom line on your income statement. But the income statement, net income figure, also shows up in your owner's equity because it increases your retained earnings. And it also shows up on your statement of changes in owner's equity. So it'll show up a number of places, but mainly on the income statement. Merchandise inventory, we've talked about that one before. Merchandise inventory is the stuff a company has that it's going to sell to a customer. If it's something it has that has value, that makes it an asset, and assets show up on the balance sheet. Other accrued liabilities. Well, that one's a giveaway. The word liabilities tells you that it's a liability account, and liability accounts show up on the balance sheet. Here's one that's confusing. Dividends paid. Dividends are monies that are given to investors, people who have bought stock, in return for letting the company use those funds. So it's paid out to an investor. So it shows up in the owner's equity account because it's a deduction from their revenues. It also shows up in the statements of owner's equity account because it's something that's been paid out to the owners. This one you should know too, cost of goods sold. Remember, this is the cost of the shirt that you purchased. To pennies, it cost them $12. Cost of goods sold is an expense, and it shows up on the income statement. Additional paid-in capital. When an investor buys stock in a firm, the investor, let's say, pays $20 for a share of stock. That stock may have a value to it that's stated at $10. Everything the investor pays over the stated value of the stock of $10 is additional paid-in capital. So that's going to be an owner's equity account, and it will show up on the balance sheet and on the statement of owner's equity. Interest income, well, that's a giveaway too. When it says the word income, you know that's a revenue account, and revenue accounts will show up on the income statement. And finally, selling expenses. Expenses again are a giveaway. Expenses show up on the income statement. So those are just a review of the types of accounts that you will have on the income statement and balance sheet, and a couple of them even showed up on the statement of owner's equity. Go through, review those account titles, the names, the term. Part of learning accounting is learning the jargon. So as you learn the terms, be sure you can identify what they are and which account they go in. So that's just a kind of a brief review. Now let's do kind of a number crunching exercise. Let's look at exercise 4 in your textbook on page 56. In exercise 4, what the authors would like for you to do is to take some information that they have from December 31st, 2004, and figure out the unknown accounts. You'll notice they have some question marks in that list of information. They've given you 3 different firms, firms A, B, and C. Let's work through firm A, and then I'll kind of let you work through B and C. We'll give you some helpful hints, then let you do them on your own. Let's do A together. Let's think about what we would need to know. If we're doing a balance sheet, we need to know that assets equals liabilities plus owner's equity. Okay. Now let's talk a little bit about what owner's equity equals. Owner's equity consists of paid-in capital, which I've denoted there on that slide as PIC. paid-in capital is the stock, and ERE is ending retained earnings. Okay, so there's two things you need to know. The third set of information down there tells you how to compute ERE. Ending retained earnings is simply taking your beginning retained earnings, adding your net income, and subtracting out dividends. So if you know those three relationships, you should be able to work Firm A. So let's practice with Firm A. What do we know? We don't know assets. So here on the first line, we just put an A because that's an unknown A. We do know liabilities. Liabilities are given to us at $80,000. Owner's equity, remember, consists of two things: paid-in capital and ending retained earnings. Well, they've given us paid-in capital for the end of the year, but they haven't given us ending retained earnings. So can we compute ending retained earnings? The previous slide showed you how to compute ending retained earnings by taking beginning retained earnings, which is given to us at $50,000, adding net income, which is given to you at $68,000, and subtracting out dividends, given to you at $12,000. So if you take 50 and add 68 and subtract out 12, you'll end up with your ending retained earnings being $106,000. So going back to the original equation, A equals L, 80,000, plus OE, and OE means you take your paid-in capital plus your ending retained earnings of 55 and 106. Add those up, your assets are equal to $241,000. Now they have another one, Part B, Firm B. Try this one on your own. Let's talk about it. Let's walk through it together. Remember the three basic equations. A equals L plus OE, which tells us that your assets equal your liabilities plus your owner's equity. Remember, too, that you can compute ending owner's equity by taking beginning owner's equity, adding net income, and subtracting dividends. So what have we got? We have assets in this case, but we don't have liabilities. Owner's equity consists of $59,000 of ending retained earnings, $59,000 of paid-in capital, and $186,000 of ending retained earnings. So solving for L, now remember L is going to equal the $59,000 plus the $186,000. Together will be $435,000. Solving for L, you get $190,000. Well, they also want you to compute in here your ending retained earnings. Is that right? Beginning retained earnings, I'm sorry. You can solve for that by taking your 186, setting it equal to $124,000, plus the $110,000 for net income, subtracting out the $186,000 for ending retained earnings, and that will leave you with $48,000. In Firm C, they don't give you the ending retained earnings, and they don't give you beginning retained earnings. Well, how in the world are you going to work that one? Well, remember, assets equals liabilities plus owner's equity, and owner's equity is your paid-in capital plus your ending retained earnings. Well, you know all of those things except ending retained earnings, so you can compute ending retained earnings. If you know ending retained earnings and your net income and your dividends, you can compute beginning retained earnings. So that's what we've done there on that slide. Now, for a really difficult question, let's look at exercise 8. This is one I want to kind of give you a start on and let you go think about it as you work through the next few problems. In exercise 8, they give you the beginning balance sheet showing $320,000 of liabilities. During the year, the liabilities went down by $18,000. Assets went up by $65,000. And paid-in capital went up from $30,000 to $192,000. Dividends, declared and paid, were $25,000, and at the end of the year, the owner's equity was $429,000. What they want you to do is calculate net income. Well, in order to calculate net income in this problem, you have to calculate about 3 other things before you get there. So I'm going to get you started and let you think about it. Your book gives you the hint to tell you to set up the accounting equation for the beginning of the year, the end of the year, and the changes. So what you have on that first slide is looking at the end of the year. Okay? Go back and figure the beginning of the year, which is on the next slide. If you know the beginning and the end, then you can figure out the changes that occurred. Try that on your own. Work through it. We'll come back and talk about it before the next module.